Today I'm going to show you the portfolio, the damage it took, which stocks I bought, and the unfortunate decision I had to make, as well as a new addition to the series, the share tip of the week. And if you find it useful, please drop me one of these to support the series. The three top topics of the week start with the FCA, which is the Financial Conduct Authority, which are the UK's financial watchdog. They had done a survey that suggested that 12 million Brits could likely be going into debt or miss a bill payment. And I wanted to bring this up because it's quite a significant figure. If we look at the total population of the UK, which is estimated to be around 67 million, that's nearly 1 in 6 of us. Therefore, 1 in 6 of us could be struggling with bills or debt during this time of uncertainty. And if this affects you, it's not the end. And I very much agree with the FCA's advice. They suggest that you should contact either government-backed agencies or charities about becoming debt-free, and that also you should contact lenders. The importance of contacting lenders is that you can negotiate a payment plan. This means that you will likely not receive a mark on your credit report, but also be able to pay back this at more sustainable levels, allowing you to be less stressful as you are going towards this by paying this off, but also you may have a little bit of extra cash that you could use to be paying food and be putting food on the table. Retail sales in the UK have continued to increase for the 5th month in a row, marking them now 5.5% higher than the pre-pandemic levels in February. This has actually been pushed up by an increase in home improvement goods, which come under the category of either garden items and household appliances, which does mean that I suspect if the pandemic continues and likely a second wave happens and perhaps we go into another national lockdown, which I think will be more unlikely, that perhaps prior to this, or if you believe it would happen, a good hedge would be investing in either DIY companies, home improvement companies, or those related to the garden sector. Therefore, in my own opinion, I feel that perhaps Dunelm Group would be a good hedge if you believe a second wave of the pandemic is going to happen, as they'll likely benefit from the increased amount of sales, as not only does it allow people to exit the house and leave, they can also purchase goods to improve their own standard of living, which I think is a quality or a trend that I believe will be increasing over the next few years as more people work from home and potentially as the pandemic may get worse. On Monday, Boohoo's auditor, PwC or PricewaterhouseCoopers, announced their plans to resign after 6 years of service with the company Boohoo. Following this came a lot of panic, and I mean a lot. Shares dropped by over 20% within the day. Not to mention the fact that many people were spooked. So many people were panicking. I looked at the London South East chat boards and I regret looking, but there was a lot of fear and panic on those boards. Apparently PwC had resigned from Boohoo due to reputational reasons and therefore do not want to associate their brand with the company, and therefore will not be signing off their next results for Boohoo. This means that Boohoo will need to find another auditor soon, or there is a risk that they'll likely have to suspend their shares until they do find an auditor, which is a conclusion I wouldn't mind. In the stock market this week, according to Google Finance, the FTSE 100 has dropped by 1%, the FTSE 250 has actually risen by 1.51%, and it's currently too early in the day to talk about the S&P 500. However, this week, my portfolio has pretty much fell off of a cliff, and it marks the 4th consecutive week that my portfolio has actually underperformed the market, and I've been pulled back from being ahead of the S&P 500 just over a month ago to now underperforming the FTSE 250. My portfolio had lost 4.57% in the last week, which is a significant drop, but not that bad when you consider that Boohoo had dropped by 20% and I had a 50% allocation to them roughly. I feel that many people in this situation would start to worry and panic and therefore start buying or just excessively trading and trying to adapt their portfolio so that it's perfect and therefore they'll be fine. And whilst I've done some traits of this, I've not fully committed to that idea and I have a strategy behind it. This is a reason why I don't celebrate capital gains. Yeah, it's cool, maybe I've hit 15,000 total in the portfolio, but I'm not going to be celebrating that. After all, you haven't made that money until you press the sell button. So unless you're planning on selling soon, there's absolutely no point cheering about a short-term change. And it's the same reason for when it drops. If you plan on selling it at a low, then obviously, or you're very close to retirement and you have to sell, then yeah, that makes sense. That's a really bad thing to happen. But if you've got years to wait and you're a long-term investor, why even let it impact your mood? Like, why let it bring you down just because it's down a bit? Instead, maybe you should be more happy thinking, yes, I can buy it at a discount. And that's actually what I did. As not only was I able to buy at a cheaper valuation, but also I was able to get more insights into the company and their potential issues or red flags, allowing me to be more knowledgeable as an investor. So before diving into the biggest loser, which may be a bit obvious, what was the biggest gainer of the week? And this week, there wasn't really any top performers, just the shares that performed the least worse. And that stock was actually Games Workshop this week, and they had risen by 2.21%, although they have been trading relatively sideways for the last 2 weeks. Regardless, it's nice to see that the share is preserving its capital, although it's only just outperformed the FTSE 250 for the week. This is a stock I've been wanting to buy for the last few months, but there's been other stocks with higher value that I've seen. And no doubt if my other stocks become more stable, more fairly valued, then I will be putting more money into Boohoo, as currently it is an underweight position. Ideally, in a 6-stock portfolio, I'd like a 25% allocation, and I've only got 23.7%. For the short term, I'd like to bump it above that so that I can then purchase shares in the future when I have bigger sums of money. I believe the share price increase was due to them appointing a new non-executive director, and that likely boosts sentiment. My holding remains to be 30 shares and is currently up by 30.03%. The biggest faller in my portfolio for this week was obviously Boohoo. Boohoo shares are down 11.5% since Friday of last week. This is a significant drop, and as I said earlier, it dropped 20% on one trading day on Monday. In my opinion, this was a massive overreaction by the markets, simply because an auditor had resigned. While yes, it could point to red flags, I felt that this was completely unjustified, massively selling off, and therefore a very cheap valuation that people could have bought into. In fact, many of you had reached out to me on Twitter at Osborne Foreman, and also in the comment section down below on YouTube, and you'd wondered if I'd bought more, if I'd sold, what had I done around Boohoo. And I've made quite a few changes which I'll talk about right now. Firstly, before discussing my opinion on Boohoo, I think it's very important to disclaim that one, I'm not a financial advisor, but secondly, I'm not an auditor either. Therefore, some of these processes, rules or regulations I may not have understood correctly, or perhaps I just don't know of. Therefore, I would take my next opinion with a grain of salt, but if you are more researched than me and know the correct answer, then by all means, please leave a comment in the comment section down below. Just remember that links are blocked due to the rise of the severe amount of scamming bots I'm seeing lately. It's important to realise that AIM companies in the UK are not counted as listed companies. This means they are subject to different rules and regulations than listed companies such as those on the FTSE 350. This means that whilst I've seen the excessive use of people saying that the auditor is meant to change every 5 years, it's simply not the case. In fact, an auditor can hold this role for more than 10 years on an AIM stock. However, after this 10-year period, changes have to be made. This doesn't mean that the auditor has to stop, but rather they have to assess the potential risk of keeping them on. And they assess these threats of the association in closer detail. And they can come to a few conclusions. One of them could be putting safeguards in place so that there's not a massive impact that this auditor could have. Typically, safeguards will be put in place in terms of the contract so that the auditor is restricted from having too much responsibility. And if this is unable to be achieved, then the audit firm will either have to resign or they do not stand for reappointment. Whilst PwC have been Boohoo's auditor since 2014, I think this is a very, very good time for them to transition. And I really don't think this is as big of a red flag as many investors were saying and shown by the sell-off in the share price. I'm going to make the assumption that auditors get a fixed term contract in terms of their payment. However, in addition to this, they perhaps get a percentage bonus based on the revenue of the company. So for a company like Boohoo, whose revenue has increased dramatically, they will be getting in proportion a higher amount of pay with a percentage of that revenue. So whilst their payment may not be fixed throughout this time, the type of payment will be. I'll also assume that since the independent supply chain review by Alison Levitt, that perhaps these adjusted changes to their governance would therefore increase the workload of the auditors by a dramatic amount. Therefore, I believe that PwC have perhaps checked this out. They've adjusted the costs, they've calculated it all, and likely decided that by freeing up these workers and having them work for a different company in the same firm, that they would be able to therefore make a higher yield on their investment. mainly because auditors are also firms that are trying to make profits, and therefore I believe it was just no longer worth it for PwC to continue working for Boohoo when they could likely move elsewhere and get better money. When looking at the media articles about the resignation of PwC, a lot of them have said things like that they were doing it for reputational reasons. And whilst I've not seen the letters that PwC have written, I've not seen any evidence in these articles that states that whatsoever. And therefore I'm simply unsure if I can even trust the media articles on this situation. Since I'm unable to find them or just don't know how to find them, I'm going to assume that their reputational reasons were their genuine reason for leaving the company. So what would be some of their reasons to resign over reputational concerns? Well, this could be from suspicions of malpractice, fraud, or mismanagement in which PwC has been unable to resolve. If, for example, it is fraud and they're unable to resolve it, then why didn't they quit earlier? They have been doing their accounting for the last 6 years, so it doesn't make sense to me, unless it is in the very recent short term that this has been a suspicion for them. Why would they have not left earlier on in their contract? Furthermore, it would make more sense as an auditor, in my limited perspective, that they would cut free from Boohoo as early as possible if this was the case. Rather, they are still helping Boohoo look for a replacement auditor. And whilst this, yes, could be a thing for their clientele so that clients going towards PwC know that they'll at least help them find another one, I would say that the reputational risks of being with Boohoo, if it is a fraudulent company, would be far higher than cutting free early. On the other hand, aren't auditors rewarded, maybe not in cash, but by recognition if they're able to detect fraud or malpractice and counter it? At least to me, it doesn't seem that PwCs are primarily reputational, but rather they're using this as a guise to end their contract and move on. Perhaps there are some reputational risks that they don't want to associate with, but this gives them a good time to say, you know what, we're not really getting paid enough for this, and therefore we're going to change, we're going to move on, and therefore another auditor can take our place and perhaps take the higher workloads. Therefore, because of this analysis, I decided that I wasn't going to sell my position, cut where I was, but rather I was going to continue to buy more at a discount valuation. And if you're interested in buying stocks and shares for yourself, sign up to my link to Trading 212 in the description down below, and you can get a free share worth up to £100. Last week, I had a total of 2,000 shares of Boohoo, and they had an average price of 246.4 pence each. Now I hold 2,500 shares of Boohoo, and they have an average price of 248.4 pence each. In turn, this pulls my position size with Boohoo up to 51.3% of the portfolio, as over this time period it had been reducing, which would be massively overweight considering I'm after a 30% allocation in a 6-stock portfolio. However, I feel that in the short term, I can get more value out of this stock and therefore won't have to top up as early in the long term. As I'm planning to hold this for a much longer period, it means I can then put my focus on other stocks if their growth excels my other stocks in the portfolio. Which very much prior to this crash, Boohoo were my top performing stock. And whilst I'm now up 12.35%, I think earlier last week I was up at least 30%, and prior to that it was even higher. So which other stocks have I bought this week? Well, I had bought more shares of Softcat after their report of earnings. This was worse than expected as their future guidance wasn't so bullish on the company. Therefore, investor sentiment had lowered and a slight sell-off of around, I believe, 6%. Currently, for the last week, they're down about 5% now, but I managed to average down on my position, increasing my total amount to 102 shares. At an average price of 1,216 pence per share. This means that I'm currently down 2.7% with my position on Softcat, but I'm very much bullish on the future, as I've said many times before. But what I'm going to be doing is not buying as much each and every week, but just casually topping up here and there with the stock. However, in honesty, I didn't have an adequate cash position, and that's why I had to make some serious changes to the portfolio. So otherwise I wouldn't have been able to have bought as much shares as I did with Boohoo. And whilst I did deposit as much as I could, which was £250 in the last week, I could have gotten a lot more shares if I had cash on the sidelines. Therefore, I had to trim back some of my other holdings in order to purchase as much of the Boohoo stock that I did. And whilst yes, I do plan on rebuilding them, it may come as a shock to you because they are stocks I am very bullish on. It's just I feel that the opportunity cost would have been much more effective with Boohoo than it is with these other stocks in this time frame, and that they have less short to medium term growth potential than Boohoo, and then I can just re-enter these positions back over the next few months and build them up. So which stocks did I sell and how much? Firstly, I sold 5 shares of Halma, which may be a complete surprise because I did state this 5 videos ago in my stocks to buy and hold for life that I would be trying to buy and hold Halma for life. And this is very much a case. This is a very insignificant amount of my position. I think I still have 25 other shares, so I can top this back up within a standard time period. My main belief that the drive of the share price is mainly due to merger and acquisition activity, which I suspect will remain to be at a lower pace than it was this time last year. Therefore, I feel that it's reasonable to sell out a small position of this because I can build this back up in the future, but therefore also benefit when they do get further mergers and acquisitions in the future. It just allows me to move some money and profits away from this stock, put it into Boohoo, and then just purchase this back with relatively low risk in the future. Although I did sell one stock to the extreme, which meant I'd cut my position by around 80%. And I did this because I wanted to minimize my risk to the speculation on an acquisition. And this acquisition was Refinitiv. And whilst lately they have stated, the London Stock Exchange Group have stated that they expect the Refinitiv deal, which is over $27 billion, to be completed by the end of the first quarter in 2021, I am not as confident. I believe that in the Brexit negotiations, the EU could use this group as leverage and say, well, if this happens, they won't get Refinitiv or some other things that may block this transition or transaction as part of negotiations. And therefore, I just wanted to minimize my risk to it. I'm still bullish on Brexit and the outcome, and therefore I will be rebuilding this position over the medium to short term, but it gives me time to therefore average down if possible. And over the last week, they have been dropping quite poorly. In the last 5 days, for example, they are down 4.61%, and I sold a majority of this before they had dropped this much, and I think they were only down 0.2% when I'd sold a majority of my holding. The mindset behind it is that I believe for the next 6 months that this share price will remain relatively flat, trading sideways, in which I can then build back up this position before they acquire Refinitiv, and therefore hopefully not miss out on anything but benefit from buying more Boohoo. The share tip of the week is a value recovery play with medium to high risk. And this is a stock that the reason why they had lost a share price or gained in potential value is because they had released a profit warning. Whilst the industry is in an excellent spot, the company itself has had some issues with their assets. This stock has a market capitalization of 1.55 billion and is listed in the FTSE 250. This stock is in the materials sector and they actively engage in the development, the mining and exploration of a specific commodity, and this commodity is gold. Sentiment were an excellent performer earlier in the year, and this is because the asset of gold has been rising rapidly. This is over fears of a second wave, perhaps being in the deepest recession ever, so therefore it does make sense why gold has been rallying. So therefore I feel that Watt's not in a better position to benefit from this potential uptrend than the gold miner themselves. However, they had to issue a profit warning and therefore could be losing a substantial amount of their earnings because they had to shut down a proportion of their mine in their Sukari mine. This is because there were detected ground movements, which effectively mean that it would be unsafe to continue mining at the rate they are, and they've got to do a lot of risk calculations, assessments, and therefore resurvey the land to see if it's safe to continue. This could mean that in the short term, their mining land and that asset may be less yielding, but it does mean if they're able to overcome this, which may be a very complex process and I don't know too much about, if they are able to overcome this, you may be getting an excellent price on this stock that could increase their revenue quite dramatically with the selling of gold, especially when it rises. I suspect this could be an overreaction by investors as the stock is down by over 32% in the last month. I think they were an excellent dividend payer, whilst they may not commit to as high as it was and there may be a dividend cut incoming, that this could be a good enough value to purchase in and start building a position. Although it very much depends if they're able to overcome this issue and if it's an easy one to deal with or not. If you're interested in the parent company of Paddy Power, Betfair and the Stars Group, then why not check out my Flutter Entertainment stock analysis. Thank you for watching. I'm Osborne Foreman. Stay safe.